The balance of payments is a financial record of a country's transactions with the rest of the world for a given time period, usually over 1 year. This includes the country's trade in goods and services with other countries. The role of the balance of payments is to record credit items, which are all payments received from other countries, and debit items, which are all payments made to other nations. Credit items on the balance of payments include revenues earned from the export of goods and services, foreign direct investment, and capital transfers. For example, the expenditure of French tourists visiting the UK would be recorded as a credit item on the UK's balance of payments. Debit items on the balance of payments include the purchase of imports of foreign goods and services, income transfers overseas, and the reparation of profits for multinational companies in the economy. These transactions have a corresponding outflow of money from the domestic economy. Essentially, the balance of payments is a record of a country's sources and uses of foreign exchange with its trading partners. In theory, the balance of payments must always balance over time because a country, like an individual, can only spend what it earns. Examples of credit items for the UK economy would include the purchase of UK-produced chemical products by German companies, American tourists flying to the UK on British Airways, global sales of Harry Potter books by British author J.K. Rowling, and or French tourists buying theater tickets to see Les Mis in London. Example of debit items for the UK economy would include UK government maintaining foreign embassies overseas, UK supermarkets purchase of Australian wine and meat products, a large British firm buying a fleet of trucks from Japan, and or the UK government paying interest on its borrowing, which are debts. The balance of payments consists of 3 accounts: the current account, the capital account, and the financial account. The structure of the balance of payments accounts can be seen in this table. This can vary from one country to another. However, the version here is used in the IB Economics curriculum and assessment. The current account is a record of all exports and imports of goods and services, plus its net investment income from overseas assets and the net balance of transfers made between countries by individuals and governments. The account is usually reported per year. There are 4 components of the current account. Balance of trade in goods. It records all exports and imports of physical goods, such as rice, computers, motor vehicles, between a country and the rest of the world. Balance of trade in services records all exports and imports of services, such as insurance, banking, management, consultancy, and tourism, between a country and the rest of the world. Income records the income receipts, which are inflows earned from foreign investments minus the income payments, which are outflows, of factor incomes paid to foreign investors. Investment income consists of the inflows and outflows of wages, rent, interest, and profit. Current transfers records the inflows and outflows of payments that are not made in exchange for anything, such as official development assistance, grants, concessionary loans and donations, between a country and the rest of the world. The balance of trade, or trade balance, is the difference between a country's total export earnings and its total import expenditure on both goods and services. The balance of trade is typically the largest component of the current account. A current account deficit occurs when a country spends more money than it earns. So, an example, the sum of money flowing out of a country exceeds the money flowing into the country. A current account surplus exists if a country has a positive net balance on its current account. A current account deficit can occur due to a combination of two factors. 1. Lower demand for exports. This is mainly caused by exports being relatively more expensive to foreign buyers. It can be caused by higher labor costs in the domestic economy, falling incomes, perhaps due to a recession, or a higher exchange rate making exports dearer. 2. Increased demand for imports. Domestic buyers tend to buy more imports if they are relatively cheaper and or of better quality. For example, a higher exchange makes it cheaper to buy foreign goods and services. The capital account is the smallest component of the balance of payments. It records the different forms of capital inflows and outflows of a country during a given time period. For example, foreign currency flows and bank deposits. Here are some examples. If Indian citizens buy shares in American banks, this is recorded as a credit item on the USA's capital account and a debit item on India's capital account. However, the dividends earned by the Indian shareholders would be a credit item for India and a debit item for the United States. If Chinese citizens purchase U.S. government bonds, the U.S. receives a capital injection of money. It's a credit item, whereas China will have a debit or an outflow on its capital account. The two components of the capital account are capital transfers, which are the net monetary movements of capital goods used in the production process, such as machinery and equipment, and financial assets, such as investment grants and debt forgiveness. Example, the cancellation of debts for highly indebted poor countries. The other component is the transactions in non-produced, non-financial assets, which are the exchange of money in non-produced assets, such as natural resources, commodities such as minerals, and tangible assets, such as patents, copyrights, trademarks, and internet domain names. Financial assets, such as money or bonds, are of little physical value. The paper they are printed on is of little value. Instead, their value is based on what the assets represent. By contrast, non-financial assets, such as gold, are assets with physical value. Less economically developed countries, or LEDCs, tend to have a capital account deficit as there is financial instability and mounting government debts and loans. The financial account records a country's net transactions in external financial assets and liabilities. For example, foreign direct investment, the purchase or sale of real estate, and investments in stock markets. It records the difference between sales of domestic assets to foreign buyers and purchases of foreign assets by domestic buyers. A financial capital inflow occurs when foreigners loan money to domestic citizens by acquiring domestic assets. The three main components of the financial account are direct investment, which refers to the inflows and outflows of long-term investments in physical capital. For example, foreign ownership of domestic assets such as property and land. Direct investments are mainly undertaken by multinational corporations. Portfolio investment is the buying and selling of stocks, shares, government bonds, pension funds, and other financial investments in foreign companies is collectively known as portfolio investment. Essentially, these assets represent international borrowing and lending. And the third, reserve assets. This refers to official reserves that are readily available to a government for direct financing of international payments and balances and to affect its exchange rate. For example, gold reserves and foreign exchange assets. In theory, the overall balance of payments must always balance because in the long term, a country can only spend what it earns. An example, the sum of all credit items equals the sum of all debit items. However, it is possible to run a deficit in one component of its balance of payments so long as it can balance this by having a surplus on another account. For example, Hong Kong has a deficit on its current account but funds this by having a surplus on its financial account due to favorable conditions for FDI. An example, it must have a surplus to provide it with the foreign exchange to pay for the excess of imports over exports. China, Norway, Germany, and Saudi Arabia have a current account surplus, but can run a deficit on their capital account or financial account by directly investing the surplus in foreign countries and/or accumulating foreign currency reserves. This means that the current account and the financial account are interdependent. A country with a current account deficit consumes more than it produces, so has to pay for the extra output somehow through a surplus on its financial account. In reality, the balance of payments will not balance as there are too many transactions to account for. To resolve this problem, errors and omissions are used to represent statistical discrepancies when compiling the accounts. Therefore, the following condition must hold. Current account must equal capital account plus financial account plus errors and omissions. A current account deficit exists when the sum of the outflows from the current account exceeds the inflows into the account. For example, net import expenditure on goods and services is greater than net export earnings. A current account deficit shows the country is spending more than it is earning, so it must require more foreign exchange whilst it faces lower demand for its own currency as exports decline. In theory, the deficit is automatically resolved under a freely floating exchange rate system because it makes exports relatively cheaper and imports relatively more expensive. Export earnings should rise and import expenditure should fall, restoring equilibrium. However, this is more problematic in a fixed exchange rate system, unless a devaluation of the currency is approved. If so, this should improve the current account in the same way as with the depreciation of the currency. In a managed exchange rate system, a current account deficit is resolved by combining market forces and central bank intervention by buying and selling of foreign currencies to reduce the value of the domestic currency in overseas markets. A current account surplus exists when the sum of the inflows from the current account exceeds the outflows into the account. For example, the value of net export earnings on goods and services is greater than the value of net import expenditure. A surplus on the current account can occur due to a combination of two factors. 1. Higher demand for exports. This could be caused by improved domestic manufacturing competitiveness, higher labor productivity, or higher incomes in overseas markets, such as foreign households and firms have more disposable income to spend on the country's exports. 2. Reduced demand for imports. Domestic buyers will tend to buy fewer imports if they are more expensive or of lower quality than those provided by domestic firms, choosing instead to buy more home-produced goods and services. A current account surplus shows that the country is earning more than it is spending, so there is a greater demand for its currency as exports decrease. Hence, there is greater upwards pressure on its exchange rate. In general, a current account surplus means that the country is a net lender to the rest of the world, whereas it would be a net borrower from the rest of the world if it ran a current account deficit. A current account surplus is generally seen as positive for an economy, especially if it is due to export-oriented growth and development strategies, as used in countries such as China, India, Mexico, Indonesia, South Korea, and Turkey. Alternatively, the current account surplus could signify that the country is spending less on imports than its trading partners because of relatively lower incomes. Thus, households have a relatively lower standard of living as they are unable to access a wider range of goods and services. In addition, many countries with a persistent or rising account surplus, such as Kuwait and Qatar, are heavily dependent on export earnings and a high savings rate, but with weak domestic aggregate demand. In a freely floating exchange rate system, the currency appreciation caused by a persistent current account surplus results in a fall in the demand for exports and a rise in the demand for imports. Thus, the fall in the exchange rate automatically eliminates the current account surplus.